Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Hey, folks, chances are, if you've been around real estate for any length of time, you've heard about that beautiful thing called a triple net lease. Maybe you've heard about it. Maybe you're not super familiar with it yet. Well, stay tuned for today's episode because Ben Kogut is zooming in from Texas, and Ben knows a thing or two about triple net leases. He's been in the business for over 20 years. My goodness, Ben, you must have started when you're like 5 or something like that. You're a young-looking guy, I tell you. And he does a variety of different asset classes within triple net leases. He does all the way from, I think it's medical buildings, industrial, retail, and childcare occupied properties, which is fascinating. So a variety of different things within triple net leases. Ben, welcome to the show. Great to have you.
Yeah, thanks, Dave. Appreciate the intro.
So Ben, maybe give us a little snapshot as of mid-2026. What does the portfolio currently consist of? Like how many different properties? What's the mix look like? Do you have a particular geographic area that you focus on? Maybe just give us the 30,000-foot view.
Yes. So what our portfolio looks like, industrial buildings, shopping centers, medical buildings, childcare properties, like you had mentioned. And what they all have in common is also what you mentioned. They have triple net leases. So what I like to look for is tenants who have good quality tenants with long-term leases, and the tenants are responsible for paying the taxes, insurance, and maintenance. And really what we believe in real estate, and I think what people really underestimate, is how powerful boring can be when it's attached to great real estate and long-term tenants. And so we look for boring real estate.
So you're not really looking for properties that you're going to go in and completely turn around, rehab, revitalize, things like that. You want to buy them already chugging along, steady Eddie, boring properties, and just plug and play. Am I understanding that correctly?
To an extent, yeah. So there is a lot of different ways to add value in these types of assets. One example would be a blend and extend. We've done that many times. What I mean by that is there's already a tenant there. They want to stay, but they need some TI, or they need some sort of something given to them. And in exchange, they're willing to sign a much longer term lease. And so we can, structure a deal where we can add value to us and our investors by having that long-term lease. And in exchange, we can provide some sort of resources to the tenant and make it worth their while to extend those leases. So that's one way to do it. We also do sale leasebacks. So for example, we work with tenants who already, their business is going great. They own their real estate, and they're now at a point where they want to unlock some of the value, some of the equity that's in that real estate, and use that to invest in their own business. And so what we do is we come in, we'll buy that real estate that their business occupies. That unlocks the equity that they can go use and help their business grow exponentially. So those are a couple of different ways where we can still add value without having to necessarily go in and have a big construction project.
So with the first example that you gave us, can you walk us through maybe a case study? You don't have to use anybody's names, but just maybe a deal that pops into your mind. What did it look like before you got involved? How did the process go? What did it end up like?
Yeah, so imagine a tenant like Caliber Collision as an example. So they are a collision repair business, and they have roughly 6 months left on their lease. And the landlord doesn't have the funds available to provide some money to the tenant. The tenant's been there for 15 years. They want to repaint, they want to fix up, the roof and fix up certain things around the property. And if, they're planning to stay there for another 15 years. And so we come in, we buy it from that seller who really thinks they're about 6 months away from having a vacant building. So that's when we come in, and then we sit down with the tenant prior to closing, we negotiate a fair and with a deal where we can provide, like I said, value to the tenant. And then we come in, we raise the capital from accredited investors, and then we go to, put the deal together, and we make it such that it's cash flowing. That's the passive income part for our investors, where they get a dividend every month because we collect rent every month from this tenant.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
Okay, that makes a ton of sense. So at this point, like, do you guys have specific geographic areas that you like to focus on? Or you kind of, doesn't matter as long as the deal makes sense? What is that?
Yeah, United States of America is where we buy, and we happen to really have a lot of relationships in the Midwest. So that, including Texas, Oklahoma, Missouri, Kansas, sometimes Michigan, Indiana, sort of right at the middle of the country is where we've found most of our success.
And what is the typical exit plan on these kind of properties? Because you talk about you want to get in there, you're looking for boring, steady Eddie kind of returns. Do you ever want to sell them, or do you just, what does that look like?
Every deal sort of stands on its own and has its own horizon. Some deals could be 2-3 years. Some deals could be 5 to 7 years. It really just depends on where we're at in the cycle and what the value add is. Sometimes we need to wait to get to a certain point in order to implement these plans. So it depends answer.
Yeah, that makes sense. So over the years, I think you've raised like well over $100 million for your deals. I think you've got over 300 different investors that you work with. These days, are you typically syndicating these deals? Are you running a fund? What does the capital side of things look like for you, Ben?
Yeah, we syndicate. Yeah, we have usually it's $100,000 minimum for investors to participate. And we find that investors who are looking to be an LP in a deal where we have these unit economics of the tenant are sound. I mean, everything is structured in a way where we can put the investors first. And so the first questions we ask, is how could or should this deal go sideways? And we want to make sure we mitigate those risks every step along the way.
Yeah, interesting. So reading between the lines, there's two things that you're really kind of looking for in a deal. It sounds like you're looking for a seller who's motivated. The two examples you gave me there were, one, it's a seller who thinks he's going to be losing his long-term tenant, so he doesn't have the money to keep them himself, or he doesn't think he does. The other option is a company that actually owns their own property, but they're looking to get the money out of that property to use it to grow their business. So there's that side of things. The other side of things is having a really good, solid tenant in these properties that's going to be there for 5, 10, 15 years, reliably. So tell me a little bit about how you find the deals, how you evaluate the tenants. Do you ever buy properties that you have to get new tenants into? Are these all like single tenant properties? Do you have multi-tenant properties? Maybe fill in the blanks a little.
Yeah, a lot of questions to unpack there. But yeah, we do single tenant and multi-tenant. We find deals. A lot of them are just relationship based. We have a great reputation in the industry, so a lot of brokers bring us deals. We love to pay broker commissions. I'm involved in several private real estate investment groups as well, so I find a lot of deal flow that way. And at the end of the day, tenants, there's a lot of it's not usually real estate problems. It's usually there's some sort of people problem. And so that could be it could be like a partnership breaking up, or maybe there's a loan that's coming due and there's now a motivation, or we've bought from REITs who have a mandate to sell within a certain period. And so we make a lot of offers on those types of things. And we look for ways where we can solve problems, and usually you have to get really creative in these types of deals. And yeah, I mean that's really been kind of the secret of our success is looking at the people and building those relationships both on the seller side as well as on the investor side. Because really, I think real estate is, people say location, 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 but I really think it's people, people, people.
Interesting. Yeah, that makes a lot of sense. So a lot of people get really excited when they first understand the big benefits of triple net investing, right? That you don't have to, deal with the tenants. You're offloading the taxes on the tenant. You're offloading a lot of the maintenance on the tenant. It's just like what you're bringing in is pretty sweet there. It's not all perfect. It's not a perfect situation. What are some of the pitfalls to triple net investing in your experience, especially for newer people that don't have a lot of experience in the field?
Yeah, I think paying attention to the market rents. Some triple net deals have really spicy, really high rents going in, and that leads to really high price per square foot. And if you have something go wrong and that tenant ends up vacating either, at the end of the lease or, God forbid, before the end of the lease, then you're left with a piece of real estate that has a very high rent that is probably irreplaceable. And so we like to make sure that when that's another huge data point, is that we buy at a basis that is a below market rent. And so if that tenant was to vacate, then it actually turns into a net positive for us, potentially, because then we could set the new rate at, around market. And of course, there's going to be time and costs and commissions and TI and things like that to get to that point. And that's why you have to have that margin of safety built in.
Yeah, makes a ton of sense. So Ben, as we're kind of wrapping things up here, raising capital is a big part of what you guys do. Some folks, especially in the multifamily space, have found things to be a little rocky these days. What are you finding works best for you guys in 2026 for connecting with new investors, bringing new investors on board? What works best for you?
Yeah, we're mostly a word of mouth referral business. We've about 300 people that have invested in our deals so far. And communication, just like any relationship, we communicate with our investors in two main ways. Number one, they get a monthly distribution. So they don't have to hear from me.
I love you like a check in the mail.
Exactly. And then, of course, we provide them with a quarterly update on what's happening at the properties. And then on top of that, we do newsletters. And then here we are, doing podcasts and a little bit of like social media marketing, but that's not really a big emphasis for us. But we really just try to do the fundamentals, just try to take care of people along the way. And it just, if we keep doing that and we have a long-term vision and mentality in this business, it just keeps growing and we get blessed with new relationships and new introductions. And that's what we want to build our business on.
I gotta ask you, Ben, you probably get this asked all the time. Where'd you come up with the name Rooster Equity? What's the story behind that?
Yeah. So my last name is Kogut. And Kogut is a Polish word. And in Polish, it literally means rooster.
There you go.
So I didn't have the ego to call it Kogut Capital or this rock or that street or whatever. Like no disrespect, but I was just like, I want to do something different.
Okay.
And then when I did my research, there was nobody in our space that was using the rooster as their symbol. And so it has a personal connection to me. And then I also, pretty much every society has used roosters in a very positive way. So I was like, and then our symbol has like a shield around it to, symbolize the safety of what we're trying to create here. And so that's why it's Rooster Equity.
I like it. Very good. So Ben, I'm sure there's going to be some folks listening or watching this episode that want to connect with you. What's the best way for them to reach out and connect?
Yeah, find me on LinkedIn. That's a great way. And my name is Ben. My last name is spelled Kogut. UT, Kogut.
There you go. Or you can also check out the website, roosterequity.com. Ben, this has been a lot of fun. Thanks for being on the show.
Thanks so much, Dave.
All right, everybody. Thanks for tuning in, and we will see you on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.com.